Hello again, students. The last topic in this chapter is notes receivable, and that's what we're going to talk about in this video. I have some journal entries up here relating to notes receivable, so we are going to go over those. And I also have some information over here relating to a particular note. Let's say that we have a note for $200,000. The rate is 6%. The date is November the 15th. Term 30 days, and that would give us a maturity date of December the 15th. And the way that you calculate that is to calculate the number of days left in the first month, which would be 15. We know we need to go to 30, so we need 15 more days, and that would give us the maturity date of December the 15th. The interest formula is principal times rate times term. And since the term is going to be less than a year, we will need to use a fraction because interest rates are always given in annual percentages. So our interest will be $200,000 times 0.06, which is 6% in a decimal form, times 30 over 360. And if we have a short-term note, we typically use a 360-day year to make the calculation simple. And that would be $1,000 in interest with maturity value of $201,000. The maturity value is the principal plus interest. So let's go ahead and apply that information to the first two journal entries that we have here. The first journal entry would be to set up the note on the books with a debit. A notes receivable is an asset just like accounts receivable, so it will have a debit balance. And what we typically do is if we have a customer who is having difficulty paying the account receivable, we might set up a note for them and pay off the account. Now the difference between a note receivable and an account receivable is that we actually set up a promissory note and the customer signs it with terms so that the customer can pay over a period of time, and it has a certain interest rate. That is different from an accounts receivable because an accounts receivable is an open-ended line of credit. Okay, so if we're going to pay off the account, we would have a debit to a notes receivable, in this case for $200,000, and a credit to accounts receivable for $200,000. Now you might also set up a note when you make a sale to a customer if it's a very large sale. In that case, your credit would be to sales, and in the unlikely event that you actually loan some money to another company, the credit would be to cash. Okay? Most of the journal entries that you will have in this chapter for the problems that you have will be paying off an account, so it will be a debit to notes receivable and a credit to accounts receivable. All right, then we get to the maturity, which is going to be December the 15th. We collect the $201,000 from our customer. We're going to be debiting cash for $201,000. We'll take the note off the books, so we'll credit the notes receivable for $200,000, and we will credit interest revenue for $1,000. Okay, so those are the two journal entries that you would have if the note does not cross over an accounting period, if it is a very short period of time and does not cross over the accounting period. However, it might actually cross over the accounting period, and if that's the case, we're going to need to accrue interest at the end of the accounting period. So I've set up another situation here, same note. Now we have 60 days. The accrual period from November the 15th to December the 31st, that is 46 days. That would be 15 days in November, 31 days in December. So the accrued interest would be $200,000 times 6% times 46 over 360, or $1,533. The interest to maturity would be $200,000 times 6% times 60 over 360, or $2,000. Okay, so the $1,533 is going to accrue between November the 15th and December the 31st, and will go into this year's financial statements or income statement. The difference between the $2,000, which is what we'll actually receive at maturity, and the $1,533 will go into next year's income statement. All right. So at the end of the period, and we're going to assume that this is December 31st year end, we're going to make an entry, interest receivable, $1,533, that's a debit, and a credit to interest revenue of $1,533. Okay. Then we go to maturity, and when we get to maturity, we're going to receive the maturity value, which would be $202,000. That, of course, is principal plus interest. So we're going to receive that, and we're going to record a debit of $202,000 to cash. We're going to take the note off the books, credit for $200,000 to notes receivable. We're also going to take that interest receivable off the books. The $1,533 had a debit up here, so now we're going to credit it for $1,533. And the rest of the entry will be a credit to interest revenue for $467, which is simply the difference between the $2,000 and the $1,533. So those are the entries that you would have for a note receivable. If you have any questions on this, let me know. Thanks.